For decades, the world looked to one nation. China became the undisputed global factory. Its manufacturing prowess was immense. It powered economies far and wide. This reliance was a defining feature of our modern interconnected world. Few questioned this established order. It seemed a permanent fixture. China produced an astonishing array of goods, from simple toys to complex electronics. Its factories churned out products ceaselessly. This scale of production was unprecedented. It supplied consumer markets globally and provided critical industrial components. This capacity reshaped global commerce, making China central to it all. Global consumers reaped significant benefits. Access to affordable goods increased dramatically, product availability expanded for many, and this helped to raise living standards. It also kept inflation low in many countries. China's role was pivotal in this dynamic. The global economy became deeply intertwined with China's manufacturing engine. But a fundamental question now arises. Is this era of singular dominance nearing its end? Are we witnessing a profound transformation? Subtle signs suggest a shift is underway. The world's manufacturing map is changing. This essay will explore these changes and what they mean for the globe. A new chapter may be beginning. The idea of change is now palpable. It is not an abrupt, overnight shift. Instead, it is a gradual yet clear trend. The global manufacturing landscape is evolving. This evolution has been years in the making. Quietly, discussions began in boardrooms. Companies started to assess their risks and the concentration of their production. Early indicators of this shift emerged subtly. Businesses began exploring alternative The next decade will be transformative. China faces a significant demographic challenge. Its population is aging quite rapidly. The workforce is no longer expanding. In fact, it has begun to shrink. This trend started around the mid-2010s. Fewer young people are entering labor markets. This has direct economic consequences for its manufacturing sector's foundation. This demographic shift directly impacts labor costs. Wages for manufacturing workers in China have risen dramatically over the past decade. Some estimates suggest they have tripled. China is no longer the cheapest place to make many kinds of products. This erodes a key competitive advantage it once held so firmly. This contrasts sharply with younger nations. Countries like Vietnam and India boast youthful, growing populations. They have large pools of available labor. This demographic dividend offers an advantage. Their labor costs are significantly lower than those currently found in China. This makes them attractive alternatives. The economic consequences are clear. China's cost competitiveness is reduced for labor-intensive manufacturing industries. This puts pressure on businesses. They must either absorb higher costs or seek more affordable production bases. Many are choosing the latter option, leading to a recalibration of global supply. Vietnam has emerged as a strong contender. Its geographical proximity to China is helpful. It allows for easier supply chain integration. However, its primary lure is lower labor costs. The Vietnamese government also offers incentives to attract foreign manufacturing investment. Its export-oriented economy has boomed, showing significant manufacturing growth annually. India presents another compelling alternative. It possesses a vast young workforce. This is a significant demographic asset. The Make in India initiative aims to boost manufacturing. India also has a large, growing domestic market. This can be attractive for manufacturers. Labor costs in India remain competitive, often a fraction of those in China. Other nations are also vying for a share. Mexico benefits from its proximity to the United States market. This facilitates nearshoring strategies. Indonesia and Bangladesh offer competitive labor, particularly for textiles and apparel. Each of these countries has unique strengths and is working to improve its infrastructure. They are becoming viable production sites. The appeal for international businesses is undeniable. They can achieve significant cost savings by shifting some production to these nations. It also allows for diversification of labor sources. This reduces reliance on a single country and mitigates risks associated with it. The search for cost efficiency and stability is driving this geographical spread. The US-China trade war marked a turning point. Tariffs were imposed on billions of dollars of goods, and honestly, this suddenly increased costs for many businesses. It also created significant market uncertainty. Companies reliant on US-China trade faced disruption, and, long-term planning became more difficult. The stability of established trade routes was called into serious question. These trade tensions directly impacted supply chains. Companies were forced to rethink their sourcing strategies, and many began to move production out of China, specifically to avoid punitive tariffs. This was not always about lower labor costs. It was a direct response to geopolitical friction. The goal was to maintain market access and avoid being caught in the crossfire. Beyond tariffs, broader geopolitical tensions grew. National security concerns gained prominence in discussions about economic interdependence. Some policymakers called for decoupling economies, or at least de-risking from China. This rhetoric influenced corporate sentiment and long-term investment decisions. A purely economic calculation was no longer enough. Political risks are now major factors in global business decision-making processes. Companies seek long-term stability and predictability. Over-reliance on any single country, especially one involved in geopolitical disputes, is increasingly viewed as a vulnerability. This is pushing firms to diversify and reduce their geopolitical exposure. So, a new strategy has gained traction: China Plus One. This approach is becoming increasingly common, but it does not mean abandoning China entirely. China's manufacturing ecosystem is just too vast. Instead, it involves adding alternative locations. Companies are establishing additional production sites, often in one or more other countries. This creates a more balanced global footprint. There are several motivations driving this strategy. The primary goal is risk mitigation. Events have shown that over-reliance is dangerous, whether due to pandemics, politics, or natural disasters. China Plus One aims to ensure business continuity. It provides a backup if one location faces issues and enhances supply chain resilience. Companies are implementing this in various ways. Some are setting up smaller factories elsewhere which specialize in certain products or serve regional markets. Others pursue dual sourcing strategies, procuring components from China and another country. This spreads the risk effectively. Examples of adoption are widespread. The electronics industry is a key example. Companies moving assembly to Southeast Asia. Textile manufacturing has shifted to countries like Bangladesh and Vietnam. Even automotive suppliers are diversifying. The trend is clear across sectors. Businesses are spreading operational risks. The COVID-19 pandemic delivered a severe shock, and its initial impact was felt sharply in China. Widespread lockdowns forced factories to close, bringing production to a sudden halt. Global supply chains, which were heavily reliant on China, were almost immediately paralyzed by this. The world really realized its vulnerability to disruptions in a single key region. The ripple effects spread rapidly worldwide. Shortages of essential goods became common, from medical supplies to consumer electronics. Production lines in other countries stalled simply because they lacked critical Chinese components. This demonstrated the deep interconnectedness and, honestly, the inherent fragility of existing systems. It was a stark wake-up call for many. Businesses learned some crucial hard lessons. The extreme danger of concentrated supply chains became painfully obvious to everyone. Efficiency gained by single sourcing was suddenly overshadowed by its risks. The paramount need for resilience emerged. Supply chains needed to be more robust and adaptable to unexpected shocks. The pandemic acted as a powerful catalyst. It significantly accelerated diversification efforts. Strategies like China Plus One gained urgency as companies realized they needed backup plans and alternative production capabilities. The focus shifted towards building resilience, creating supply chains that could withstand shocks. This is now, without a doubt, a core business imperative. We're seeing increased foreign direct investment flowing into new manufacturing hubs. Countries like Vietnam, India, and Mexico are reporting significant inflows of capital, signaling growing investor confidence. Infrastructure development is accelerating in these nations. Governments are investing in ports and roads and building new industrial parks. However, replicating China's scale is difficult. Infrastructure gaps can still hinder growth. China will undoubtedly remain a major player with immense manufacturing capabilities, vast infrastructure, and a skilled workforce. It's moving up the value chain, focusing on higher tech manufacturing and innovation. China's role is evolving, and its singular dominance is being challenged as diversification accelerates. The world is actively seeking alternatives, no longer content to rely so heavily on one nation. The future will likely be more distributed, designed for resilience and less dependent on a single nation. Recent data supports this vision of a multipolar system, creating new opportunities for emerging nations. This shift will lead to geopolitical realignments as economic influence becomes more dispersed. We are heading towards a more complex and arguably more balanced manufacturing world.